At this point in the course, we've explored the regulatory metrics, the organisational structures, and the strategic frameworks that underpin liquidity risk management in banking. But one question remains. How do banks make sure that liquidity is considered not just by Treasury or risk, but by every part of the organisation? From lending desks to investment arms, from product developers to relationship managers. How do they ensure that the cost and value of liquidity is reflected in day-to-day decisions, in pricing, and in performance evaluation? That's where funds transfer pricing, commonly known as FTP, comes in. In this session, we're going to examine how FTP works, why it matters, how it's designed, and what challenges it brings. By the end, you'll understand how FTP acts as the internal market for liquidity within a bank and how it transforms liquidity from a central function into an enterprise-wide discipline. Now, funds transfer pricing is an internal mechanism that allows banks to allocate the costs and benefits of funding and liquidity to the businesses that use them. Now, it acts as a bridge between Treasury, which manages the bank's funding and liquidity centrally, and the various business lines that generate and consume funds. Now, without FTP, there's no way to measure the true profitability of a loan, deposit, or trading strategy, because you're missing the cost of liquidity. Now, the basic principle is this. When a business unit uses funding, for example, by issuing a loan, it should be charged an internal rate that reflects the cost of raising those funds for the bank. Now, conversely, when a unit generates funding, say by attracting deposits, it should be credited for the value of those funds. Now, the result is an internal price for liquidity that flows through the bank's management accounts, allowing for more accurate pricing, performance measurement, and risk-adjusted decision-making. So let's look at how this works in practice. Suppose a lending desk wants to issue a 5-year corporate loan. Treasury will have to fund that loan, either by using existing liquidity, issuing new debt, or managing the asset within the overall liquidity buffer. Now, through the FTP system, Treasury will charge the lending desk a 5-year internal funding rate. Now, this rate might be based on the bank's own cost of funds, adjusted for market conditions, liquidity premiums, and regulatory costs like the NSFR. Now, the lending desk then uses this internal rate as part of its pricing model, ensuring that the interest rate charged on the loan covers not only credit risk and operational costs, but also liquidity cost. Now consider a deposit-taking desk. When it attracts stable retail deposits, it provides a funding benefit to the bank. Now, those deposits can be used to fund assets or reduce wholesale borrowing. Now, the FTP system rewards the deposit desk with an internal credit, reflecting the value of those funds. Again, this credit might be based on the market value of comparable funding, adjusted for stability, term, and liquidity profile. Now, this creates incentives for deposit desks to attract stable, low-cost funding, and for lending desks to use liquidity wisely. Now, FTP can be applied in different ways depending on the bank's structure and objectives. In its simplest form, FTP uses a central pool model where Treasury acts as the internal bank. Now, all business units transact with Treasury rather than each other. Treasury then sets the transfer prices based on market rates, funding strategy, and regulatory requirements. Now, this approach allows for centralized control and consistency across the organization. Now, a more complex approach is dual FTP, where both interest rate risk and liquidity risk are priced separately. Now, in this model, one component reflects the term structure of interest rates, often using a risk-free curve like SONIA or Euribor, and the other reflects the liquidity premium required to fund different types of assets. Now, this helps separate the pure funding cost from the liquidity value, giving more granular insights into business performance. Now, some banks go even further, introducing behavioral FTP. Now, this means adjusting the transfer prices based on expected, not contractual maturities. For example, a retail current account may be contractually callable on demand, but in practice, customers leave their balances untouched for years. Now, the FTP system can model these behaviors and assign longer effective maturities, resulting in higher internal credit for the deposit desk. Now, the same applies to prepayable loans, where behavioral models adjust the funding charge based on the expected life. Now, one of the key benefits of FTP is that it embeds liquidity considerations into product pricing. When a lending desk sees a higher FTP charge for a long-term illiquid loan, it may adjust its pricing, reduce its term exposure, or explore alternative structures. When a deposit desk receives more credit for stable funding, it may invest more in customer retention and relationship building. Now, these behaviours improve the bank's overall funding profile and reduce reliance on volatile sources. The FTP also enhances performance management. By assigning funding costs and credits at the business unit level, FTP allows management to assess profitability on a more realistic basis. A product that looks profitable on a gross margin basis may turn out to be value destructive once liquidity costs are factored in. And conversely, a deposit product with low interest revenue may be highly valuable because it provides stable, cheap funding. The FTP helps surface these dynamics, enabling better decision-making and resource allocation. Now, in the context of regulation, FTP supports compliance with liquidity rules like the LCR and NSFR. Now, by making business units aware of the funding implications of their actions, FTP helps align day-to-day activities with regulatory requirements. For example, if the NSFR penalises short-term funding, Treasury can reflect that cost in the FTP curve, discouraging business units from creating maturity mismatches. FTP also supports ILAP by showing how the bank manages liquidity internally and how costs are distributed. Now, designing an effective FTP system is not without its challenges. One of the biggest is transparency. Now, business units often question how the transfer prices are calculated, particularly when they change. Now, to be credible, the FTP methodology must be well documented, explainable, and aligned with market reality. Treasury must engage with the businesses, provide clear rationale for pricing decisions, and be open to feedback. Another challenge is consistency. The FTP system must be applied uniformly across products, business lines, and geographies. Inconsistent application can lead to gaming, arbitrage, or misaligned behaviours. It can also distort performance reporting and reduce the value of FTP as a management tool. Now, a further challenge lies in accuracy. FTP relies on inputs from multiple systems, market rates, behavioural models, balance sheet data, and regulatory calculations. Errors or delays in these inputs can create noise in the transfer prices, leading to incorrect signals. That's why many banks invest in dedicated FTP infrastructure, including automated data feeds, audit trails, and analytics dashboards. Now, governance is also key. Most banks have an FTP committee or Treasury forum that oversees the design, implementation, and periodic review of the FTP framework. Now, this committee includes representatives from Treasury, risk, finance, and the businesses. It sets the pricing methodology, approves model changes, and ensures alignment with strategic objectives. In some banks, FTP is subject to internal audit or external review, particularly when it plays a material role in business planning or remuneration. Now, as with many aspects of liquidity management, FTP has evolved significantly over the years. Now, in the past, many banks used static or overly simplistic FTP models, often based on book rates or average costs. Today, leading institutions use dynamic FTP models that reflect current market conditions, regulatory constraints, and behavioural insights. Now, these models are updated regularly, stress-tested, and aligned with risk appetite. There's also a growing interest in using FTP to manage contingent liquidity risks. For example, a business unit that originates large undrawn credit lines may be charged an FTP add-on to reflect the potential drawdown risk under stress. Now, similarly, businesses that generate volatile funding flows may be penalised, while those that deliver consistent, sticky balances receive more favourable treatment. This extension of FTP helps align business activity with the broader liquidity risk framework. Now, the use of FTP also intersects with climate risk and ESG considerations. Some banks are exploring green FTP curves, where funding costs are adjusted to reflect the sustainability profile of a product. For example, Green loans or climate-friendly investments may receive more favourable FTP rates, encouraging the business to support ESG objectives. Now, while still emerging, this is part of a broader trend to integrate sustainability into financial risk management. Now, in the context of digital banking, FTP faces new challenges and opportunities. Customer behaviours are changing, balance volatility is increasing, and data analytics are becoming more sophisticated. FTP systems must adapt, using real-time data, advanced behavioural models, and machine learning techniques to better estimate liquidity patterns and assign transfer prices. Now, as embedded finance and digital platforms grow, FTP will need to evolve to support these new business models. To summarise, funds transfer pricing is a powerful tool for embedding liquidity risk awareness throughout a bank. It ensures that funding and liquidity are not just managed centrally, but shared, priced, and owned across the business. It creates incentives, supports strategy, enhances performance management, and helps deliver regulatory compliance. Done well, FTP transforms liquidity from a cost centre into a driver of value and resilience. In our next session, we'll look at how banks prepare for the unexpected through contingency funding plans. We'll explore what makes a good contingency plan, how banks simulate crisis scenarios, and how they ensure that liquidity actions can be taken quickly, effectively, and with confidence. I'll see you in the next session.